Chuck Carnaval, and I'm the Chuck in the Markets Upchuck. And today's blog was titled Growth and Income Opportunities, where I'm pointing out that thanks to the recession, we've got some tremendous opportunities to buy some of the, America's best companies, literally at valuations that we haven't seen in decades. And I'm going to go through 5 examples, and I'm going to look at them from the perspective of getting some nice solid growth. These are all what I call, what Peter Lynch in his book One Up on Wall Street would have called stalwarts, with the exception of the last one. But the first 4 will be stalwarts. These are companies that are growing around 10 to 12 or 13% a year and have a long history of paying very attractive dividends and increasing those dividends. And my first example here is Pepsi, and this is using the Graham-Dodd chart for valuation, where we are illustrating here what the normal valuation of this of each of these companies would be relative to their earnings growth rate. So the blue line here with the asterisk represents their normal price earnings ratio adjusted by Graham-Dodd. And as you can see, PepsiCo has historically traded somewhere around 20 times earnings. The actual number here is 23.2. But you can see it was trading at 23.2 times earnings up through 93. Then we had a dip. And I want to point out that was a great time to buy PepsiCo, because you can see the price rallied very strongly for the next 4 or 5 years. A little bit of earnings, inconsistency here, but still very strong earnings, good growth. And we had this nice period, since 1999, where Pepsi's earnings growth has been very strong. They've averaged just under 10% a year. And what I really want you to notice is that the stock price is trading at a discount to that growth rate. It only, has been at that much of a discount, maybe possibly right here back in 1994. Otherwise, you'd see the company is traded pretty much in line with its earnings. The turquoise area here shows the dividends. And I'm going to spend a little more time on this chart, and I'll be quicker on the rest of them, just so that I'm going to make sure everyone's familiar that's looking at these tools. So you've got earnings correlated drawn here. You've got the stock price correlated to those earnings. And then this turquoise area shows the amount of dividends that are coming out of these earnings that are paid to shareholders. And then down here at the bottom, I have a performance chart, which simply shows if you put $100,000 in the stock on the first day of this chart and held it to the last day, what would your performance have been? And I've compared that to the quote-unquote stock market, the S&P. So $100,000 in PepsiCo would have grown to $570,958.60, and that's a 9.4% rate of return, and that's in comparison to the S&P 500, where $100,000 would have grown to $279 and a 5.4% return. But what I really want to focus on now is the income side. In 1990s, you can see Pepsi paid 18 cents a share, and they were yielding about 1.9%, which I might add is what you would normally expect to get a yield off of Pepsi historically. But today, as you can see, the yield is 2.9. It's almost 3%, which is very high relative to normal. And that's because the stock price, as I point out in the written blog, is so cheap that you're getting some extra yield. So this is really a very high quality company that has a long history. As you can see here, in 1991, the dividend increased to 22 cents, and so therefore on $100,000, your income went from $1,878 to $2,296 to $2,600, and you can see how this just happens year after year after year. What's happening is they're raising their dividend at just about 10% a year, which is relatively consistent to their growth rate, because that's typically what these companies do. Their payout ratio stays pretty much the same, but over this 20-year period, PepsiCo would have paid off $136,000 in income. But let's say you were 10 or 15 years away from retirement. You could see your income off of this holding increasing dramatically, notwithstanding the fact that you're seeing a significant rise in your actual value. Now let's compare that, if we will, to investing in a bond. Today, current Treasury bill, 10-year Treasury bill yields, the highest quality, of all, are yielding about 3.54%. So if you put $100,000 in a T-bond, you would expect to, receive $3,540 a year each year for the next 10 years. If you put that same amount of money in PepsiCo today, you would earn 2.9%, or just a little more than 0.5% less. But you would see if you compare it to what happened here, you would see your income increasing every year based on their normalized historical growth rate. I'm going to move on to my next example now and be a little quicker. I want you to notice Colgate. Again, you see this very strong correlation. Anytime the stock price is below this earnings justified line here, based on the Graham-Dodd analysis, it's very attractive. You can already see that Colgate-Palmolive fell, more than it should have. The stock's already recovered, but you could still buy this company with a 2.2% dividend yield today. And once again, I want you to notice their third dividend, very similar to PepsiCo, has increased every year, so that over a long period of time, your income from this stock, you actually get a raise in pay every year, as I say at the back half of the blog here today. This company's grown 11.6%. It's obviously an extremely high quality company. $100,000 here would have grown to over $1 million. That's a 12.9%. It actually has a faster growth rate than Pepsi compared to that same number in the market, and your dividend now would have thrown off over $218,000. Another very attractive opportunity that is available today because the market price has panicked. You can see very little has happened in Colgate to warrant this kind of a price drop. Moving on, if I look at Procter & Gamble, here's another example. Look how strong the correlation to stock price was. You can buy Procter & Gamble today with a 2.8% dividend yield. That's precisely what you could have bought it 20 years ago. And, look what happened as the company continued to raise their dividend year after year after year, how the income increased. This is another example where $100,000 would have grown to $646,000 compared to only, 279 in the S&P. That's almost double or just under double the rate of return. But here you've got a very strong dividend that is very competitive to what you can get on a current treasury bond, and yet you would expect to get an increase every year if things go like they have in the past. The current forecast for Procter & Gamble is to grow at about 10% a year going forward. That means if you bought the stock today and they traded at, even a 15 multiple, which is very conservative for this company, you would expect by 2014 this to be an $87 stock that you can buy at $51 today. And remember, you're getting a nice dividend income with an opportunity to see that dividend income increase every year. The next example is Johnson & Johnson. Once again, you see the same story. This is the only time in the last 20 years, 2 decades, where you have been able to buy Johnson & Johnson at this low a valuation. Otherwise, it's always traded at, a price-earnings ratio certainly above, the current 12 that it's trading at. And most of the time, it's traded at around 18 to 20 times earnings. You get a 3.2% dividend yield today, and if you look at it historically, again, this company has generated a very attractive long-term rate of return of 11.7%, very consistent to its earnings growth rate as usual. $100,000 would have grown to $864,000 compared to the market's $279. But look at your dividend income stream. Every year you can, these and shareholders over the last 20 years have seen their dividend increase year after year after year to where their yields in later years become extraordinary because you're participating in the growth and you're getting a raise in pay because they continue to pay out, a normal percentage of their earnings growth in dividends, and that rewards you as a shareholder very nicely over time. My final example is Paychex, which is a payroll processing and benefits company. And as you can see, this company is different than the other 4. This company has a very, very strong growth rate. They've averaged over 22% a year. They did start paying a dividend, several years ago. Actually, back in 1990. They were paying a very small dividend, but that dividend began to grow in the mid-90s, and it went from 2 cents a share to 3 to 4 to 7 to 10 to 15. And what you have here are 2 things I want you to focus on. One is you got an opportunity to buy a much faster growing company with a higher yield because the price of the stock has really been beat up quite a bit here by the market in the current recession. I do believe this company is going to recover very nicely as the economy gets strong again, and you can see the stock price is already starting to recover. But a $100,000 investment in this company would have grown to over $3.5 million. That's a 20% rate of return versus that 5.4% in the market. But look at your dividend yield. Look how much dividend income you got from owning this company over a long period of time and participating in both the growth of the business as well as the income generous dividend payout that the company began to institute. More in the middle 90s. They were paying a modest dividend in the early part of the 90s, but then once we start getting into 95, 96, and 7, you can see that dividend began to increase at a very nice rate, consistent with its long-term growth rate. We're forecasting about a 12 or 15% growth rate going forward. I don't think you're going to see the historical number here, come to pass, but you should get very, very strong growth, a very attractive dividend yield of 5%, more than you could actually get in a 10-year Treasury bond now. And I think if you're a long-term holder and be able to buy this company at these, relatively low valuation, you could do very, very well. So this could be like a turbocharger or kicker. So here's 5 examples of companies where you can get good, rich dividend income, participate in long-term growth, especially as the economy recovers, and generate, I think, some very, very strong returns without taking, a massive amount of risk to do it. This is Chuck Carnival. I hope you enjoyed today's blog, and I'll look forward to talking to you again tomorrow. Thanks for listening.